On November 2, 2022, FTX was worth $32 billion. The crypto exchange was processing millions of transactions daily, sponsoring stadiums, running Super Bowl ads, and its founder was being compared to Warren Buffett. 10 days later, FTX was bankrupt. Not struggling. Not downsizing. Completely insolvent. $8 billion of customer money had simply vanished into thin air. This wasn't a market crash. Bitcoin was still trading. Ethereum was still functioning. Every other major exchange was operating normally. This was something different, a controlled implosion so sudden and complete that it sent shockwaves through an industry that thought it had seen everything after years of volatility and scandal. But here's what makes this story truly disturbing. FTX wasn't some sketchy offshore operation run by anonymous criminals. It was regulated in multiple jurisdictions. It had celebrity endorsers, Tom Brady, Steph Curry, Larry David. It counted major venture capital firms as investors, Sequoia Capital, SoftBank, Ontario Teachers' Pension Plan. These weren't amateur speculators being fooled. These were supposedly sophisticated institutions conducting due diligence and staking their reputations on this platform. So how did a company valued at $32 billion collapse in less than 2 weeks? How did billions in customer deposits disappear? And why didn't any of the supposed safeguards, auditors, regulators, investors, media, catch what was happening until it was far too late? The answer reveals something more frightening than simple fraud. FTX's collapse exposed fundamental flaws in how we regulate financial innovation, how we measure risk in emerging technologies, and how marketing and narrative can override basic financial scrutiny. This wasn't just one bad actor. This was a systemic failure involving multiple layers of oversight that all failed simultaneously. What you're about to discover is how a former Wall Street trader built a crypto empire on foundations so unstable that a single tweet brought it crashing down. You'll see how customer money was secretly funneled to a sister company for risky bets, how accounting was so chaotic that executives didn't know how much money they had, and how warnings were ignored by people who should have known better. This is the story of FTX, a cautionary tale about the danger of moving fast and breaking things when those things happen to be billions of dollars of other people's money. And it starts not with cryptocurrency, but with a simple arbitrage opportunity that seemed too good to be true. To understand FTX's collapse, you need to know the key figures who built this empire and the observers who failed to stop it. The founder, Sam Bankman-Fried, known universally as SBF, wasn't a typical crypto entrepreneur. He graduated from MIT with a physics degree, spent time at Jane Street Capital, a prestigious quantitative trading firm, and presented himself as the responsible adult in crypto's chaotic room. He lived modestly, drove a Toyota Corolla, preached effective altruism, and pledged to give away his fortune. Media outlets portrayed him as crypto's savior, the one who would bring legitimacy and regulation to a Wild West industry. That carefully crafted image would prove to be one of the most successful deceptions in financial history. The inner circle. Caroline Ellison ran Alameda Research, FTX's sister trading firm. A Stanford graduate who'd also worked at Jane Street, she became the operational link between FTX and Alameda. Gary Wang, an MIT classmate of SBF's, served as FTX's chief technology officer. Nishad Singh was the engineering director. This tight-knit group of 20-somethings, many living and working together in a Bahamas penthouse, controlled billions of dollars with minimal oversight and maximum access to customer funds. The enablers, venture capital firms, poured money into FTX with minimal due diligence. Sequoia Capital invested over $200 million after a Zoom call. Celebrity endorsers lent their credibility without understanding the business. Major media outlets ran glowing profiles without investigating basic financial questions. Regulators in multiple jurisdictions approved licenses without examining the relationship between FTX and Alameda. The customers, millions of ordinary people, retail traders, crypto enthusiasts, even experienced investors, deposited money on FTX believing their funds were safe. Unlike traditional finance where deposit insurance protects customers, crypto operated without such safeguards. When FTX collapsed, those customers would discover their money was simply gone, with no government backstop to make them whole. To understand how FTX happened, You need to understand the ecosystem it emerged from and the regulatory vacuum it exploited. Cryptocurrency arrived in 2009 with Bitcoin, promising a financial system free from government control and traditional banking intermediaries. For years, crypto remained a fringe technology used primarily by libertarians, technologists, and unfortunately, criminals who valued its pseudonymous nature. But around 2017, that began to change. The first crypto boom attracted mainstream attention. Bitcoin's price soared from under $1,000 to nearly $20,000. Suddenly, ordinary people wanted in. This created a massive problem. Cryptocurrencies are difficult to use. Sending Bitcoin requires understanding private keys, wallet addresses, and blockchain confirmations. For most people, this was impossibly complex. Enter crypto exchanges, platforms that made buying, selling, and storing cryptocurrency as easy as using a banking app. These exchanges served as the bridge between traditional finance and the crypto world. You could deposit dollars, buy Bitcoin with a click, and the exchange would handle all the technical complexity. Exchanges like Coinbase, Binance, and eventually FTX became the gateways through which billions of dollars flowed into cryptocurrency. But these exchanges operated in a regulatory gray zone. They weren't quite banks. They didn't offer FDIC insurance or follow traditional banking regulations. They weren't quite brokerages. They traded assets that regulators hadn't definitively classified as securities. This ambiguity gave exchanges enormous freedom but created massive risk for customers. The fundamental danger was commingling and rehypothecation. When you deposit money at a traditional bank, regulations strictly limit what that bank can do with your funds. There's deposit insurance, capital requirements, and oversight. When you deposit cash with a traditional brokerage, your assets are legally segregated. The firm cannot use your stocks to make its own bets. Crypto exchanges faced no such restrictions. When you deposited Bitcoin on FTX, legally it became FTX's Bitcoin. The exchange could theoretically do anything with it: lend it out, trade with it, use it as collateral. You had a contractual claim to get it back, but no regulatory protection ensuring the exchange actually had the Bitcoin when you wanted to withdraw. This created a classic moral hazard. Exchanges had access to billions in customer assets with minimal oversight and maximum temptation. The only things preventing them from misusing those funds were their own internal controls and their reputational interest in staying honest. For most exchanges, most of the time, this worked. Reputation was valuable, and exchanges understood that any hint of impropriety would trigger a run as customers rushed to withdraw their funds. But FTX was different because of its relationship with Alameda Research. Most exchanges simply provide the platform for trading. FTX's founder also owned a trading firm that was one of the biggest customers on his own exchange. This created an enormous conflict of interest and temptation. If Alameda needed money for a big bet, FTX customer funds were sitting right there, accessible with minimal friction. The crypto industry knew about this structural vulnerability. Every few months, some exchange would collapse: Mt. Gox, Quadriga CX, Celsius, and customer funds would disappear. But FTX seemed different. It had raised money from top-tier investors. It was applying for regulatory licenses. Its founder was testifying before Congress about how to regulate crypto properly. These signals suggested FTX was one of the good ones, a responsible actor working within the system. That confidence would prove catastrophically misplaced. The regulatory vacuum and structural vulnerabilities that enabled previous crypto collapses hadn't been fixed. They'd simply been obscured by FTX's sophisticated marketing and its founder's carefully cultivated reputation. The arbitrage opportunity 2017 to 2019. Sam Bankman-Fried discovered crypto through a surprisingly mundane observation. Bitcoin traded at different prices on different exchanges. In 2017, you could buy Bitcoin for $7,000 in the United States and immediately sell it for $8,000 in Japan. This price discrepancy, called the kimchi premium, existed because moving money between countries was slow and complicated, but moving Bitcoin was instant. This arbitrage opportunity was exactly what someone from quantitative trading was built to exploit. In 2017, SBF founded Alameda Research to capture these spreads. The firm would buy crypto where it was cheap, transfer it in minutes, and sell where it was expensive. The profits were enormous. Alameda reportedly made $25 million in just 3 weeks exploiting the kimchi premium. But arbitrage opportunities don't last. As more traders entered the space, the price differences narrowed. By 2019, the easy money was gone. Alameda needed to evolve from simple arbitrage to more sophisticated and riskier trading strategies. This meant taking larger positions, using leverage, and making directional bets on cryptocurrency prices. This evolution created a problem. Alameda needed a reliable exchange to execute its trades, but existing exchanges had limitations. Trading fees ate into profits. Exchanges sometimes froze withdrawals during volatile periods. And crucially, exchanges treated all customers equally. Alameda couldn't get special privileges or favorable terms. The solution seemed obvious: build their own exchange. In 2019, FTX launched. On the surface, it was just another crypto trading platform. But underneath, FTX was designed specifically to give Alameda advantages. Alameda got special privileges, exemptions from certain rules, access to favorable liquidation terms, and critically, the ability to maintain a negative balance by borrowing against customer deposits. The boom years 2020 to 2021. FTX's timing was perfect. In 2020, cryptocurrency exploded into mainstream consciousness. COVID lockdowns left people at home with stimulus checks and online trading apps. Bitcoin surged from $5,000 to $60,000. Suddenly, everyone wanted to trade crypto, and FTX was ready. The exchange marketed itself as the sophisticated, reliable platform for serious traders. While competitors like Coinbase were seen as beginner-friendly, FTX offered complex derivatives, leverage, and tools that attracted professional traders and institutions. Trading volumes exploded. FTX's revenue reportedly hit $1 billion in 2021. SBF became crypto's most visible spokesperson. He testified before Congress. He pledged to give away his fortune to charitable causes. He presented himself as the adult in the room, advocating for common-sense crypto regulation. Media outlets portrayed him as crypto's redemption story, proof that the industry could produce responsible leaders. This reputation helped FTX raise money at astronomical valuations. In 2021, investors poured hundreds of millions into FTX at a valuation that eventually reached $32 billion. Sequoia Capital, one of Silicon Valley's most prestigious firms, invested after a Zoom call where SBF reportedly played video games while pitching. The investors weren't buying just a business, they were buying into the narrative of SBF as crypto's savior. FTX spent lavishly on marketing. It bought naming rights to the Miami Heat Stadium FTX Arena. It ran Super Bowl ads featuring celebrities. It sponsored athletes and teams. This wasn't just brand building, it was reputation laundering. Every celebrity endorsement and major partnership added credibility that masked the problems brewing underneath. Because while FTX looked successful, its relationship with Alameda was becoming increasingly problematic. Alameda was making bigger bets, using more leverage, and losing money on bad trades. The 2021 bull market had hidden these losses, but as crypto prices began falling in 2022, Alameda's positions were underwater. The firm needed cash to maintain its positions and avoid forced liquidations. That cash came from FTX customer deposits. The exact mechanics were hidden behind accounting so chaotic that even insiders later admitted they didn't fully understand the flows. But the essential transaction was simple. FTX would create an entry saying Alameda had deposited funds. Alameda would use those phantom deposits as collateral to borrow real customer assets, and FTX would mark it all as internal accounting. The breaking point: November 2022. The house of cards began collapsing with a single article. On November 2, 2022, CoinDesk published a report examining Alameda Research's balance sheet. The findings were alarming. Alameda's assets were heavily concentrated in FTX's own exchange token. This was circular and dangerous. Alameda's solvency depended on the value of a token issued by its sister company. The report raised obvious questions. If Alameda was borrowing against FTT tokens, and those tokens' value depended on confidence in FTX, what happened if that confidence evaporated? The whole structure could collapse instantly. 2 days later, the bomb dropped. Changpeng Zhao, CEO of Binance, FTX's biggest competitor, announced that Binance would sell its entire holdings of FTT tokens. Binance had received these tokens as part of an earlier investment in FTX and now was dumping them. CZ claimed this was just risk management, but the message was clear: Binance had lost confidence in FTX. FTX's collapse is unique in its details but familiar in its structure. The same pattern, brilliant founder, revolutionary technology, sophisticated fraud, has repeated throughout financial history. Look at Theranos. Elizabeth Holmes promised revolutionary blood testing technology, attracted blue-chip investors and board members, and turned out to be running an elaborate fraud. The parallels are striking. Carefully crafted public image, sophisticated investors fooled by narrative over substance, and regulatory failures that let the fraud continue for years. Or consider Bernie Madoff. He built a reputation as a pillar of the financial community, served on regulatory boards, and was trusted by sophisticated investors. Like FTX, Madoff's scheme collapsed when customers wanted their money back and discovered it wasn't there. Like FTX, warning signs were visible to anyone who looked carefully, but reputation and relationships prevented serious scrutiny. Even closer parallels exist in crypto's own history. Mt. Gox, once the world's largest Bitcoin exchange, collapsed in 2014 when it revealed that 850,000 Bitcoin, worth nearly $500 million then, had been stolen or lost. Celsius Network froze customer withdrawals in 2022, just months before FTX, revealing another case of customer assets being used for risky investments. Voyager Digital, BlockFi, and others all failed in 2022 using variations of the same playbook. The pattern is consistent. Promise revolutionary technology, attract deposits, use those deposits for risky bets, collapse when losses exceed assets. Yet each time, the industry insists this time is different, and avoids implementing the safeguards that would prevent the next collapse. FTX also reveals the continuing problem of regulatory arbitrage. Like the savings and loan crisis emerged from deregulation, and 2008 grew from unregulated derivatives, FTX thrived in crypto's regulatory vacuum. SBF even helped shape regulation by testifying before Congress and proposing rules that would have cemented FTX's advantages while limiting competitors. Perhaps most disturbing is the sophistication of those fooled. These weren't unsophisticated retail investors, though plenty of them lost money too. Sequoia Capital, SoftBank, the Ontario Teachers' Pension Plan, all conducted due diligence and invested anyway. This suggests that the problem isn't just one bad actor, but systemic failures in how we evaluate new technologies and financial innovations. The same venture capital firms that funded FTX continue funding crypto startups with minimal changes to due diligence. The same celebrities who endorsed FTX continue endorsing other platforms. The regulatory gaps that enabled FTX remain largely unaddressed. We seem determined to learn this lesson the hard way, repeatedly, at the cost of billions in customer losses. So what can we learn from FTX's catastrophic collapse? First, reputation is not the same as reality. SBF cultivated an image of responsibility while running a fraud. Celebrity endorsements and venture capital investments don't guarantee an investment is sound. They just mean others were fooled first. Do your own research means actually examining financial fundamentals, not just checking which famous people are involved. Second, regulatory gaps create moral hazard. When platforms can access billions in customer funds with minimal oversight, some will abuse that access. FTX proves that self-regulation and market discipline aren't sufficient safeguards. Without deposit insurance and segregated accounts, crypto exchanges remain vulnerable to the same bank-run dynamics that led to banking regulation in the first place. Third, financial innovation without safeguards is dangerous. Crypto promised to revolutionize finance by eliminating intermediaries. But FTX shows we recreated the worst aspects of traditional finance: concentrated risk, conflicts of interest, opacity, without any of the protections. Moving fast and breaking things is catastrophic when those things are people's life savings. FTX lost $8 billion of customer money in less than 2 weeks. That shouldn't be possible. The fact that it was suggests we haven't learned the lessons that financial crises keep teaching. If this investigation into crypto's biggest collapse was valuable, subscribe to Financial Chronicle. We're examining the financial disasters that shaped markets and the patterns that keep repeating. What should we investigate next? Share your thoughts below. The question isn't whether another FTX will happen. It's whether we'll recognize the warning signs before billions more disappear.